Hey guys, Trevor here, and I'm here with Vince. He's a mortgage broker with the Mortgage Group, TMG. And today what we're going to talk about is a new homebuyer incentive program that just came into effect here in September. There's a lot of confusion about the program right now, so I thought I'd talk with Vince and get a little bit more information for you guys. So Vince, what could you tell us about this program? What is it?
Basically what it is, it's called the First Time Homebuyer Incentive Program put on by the government through CMHC, the Canadian Mortgage and Housing Corporation. And basically what it is, where the government's going to give you an incentive as part of your down payment when purchasing a home. The down payment incentive ranges from 5% to 10% of your actual purchase price. And the goal of that essentially is to obviously have more equity down on the property, thus reducing your monthly payments, the interest you would pay, and your CMHC premium that you would pay.
Okay, great. And so how does this program actually work?
Okay, there's a few criteria that you have to fall under to qualify for this program. Obviously, you have to be a first-time home buyer. So first-time home buyer is someone that obviously who's never owned a home before. It's their first home. The second criteria is you cannot have lived or occupied a home in the last 4 years. So you could have owned a home, but as long as you haven't lived it in the last 4 years, then you qualify for the first-time home buyer.
Oh, interesting. Okay, so just to clarify there, what you're saying is if someone has actually bought a home before, but it's been 4 years where they have not owned a home, or they're not living
so
in
that they're renting
yeah.
it out, or they're living somewhere else, and they fall under that first home buyer program. And the third thing is you have a breakdown of a marriage or a common law partnership. So you currently own a home, your marriage dissolves, and then you can go purchase another home, and you would fall under the first time home buyer umbrella.
They'll give you another shot at being a first-time home buyer again. Okay, so what would you say are the main benefits to this program?
The main benefits right up front is it'll lower your payments slightly, depending on your purchase price and your mortgage amount, anywhere up to about $200 a month savings. The second thing is you pay less of a CMHC insurance premium. Anytime you put less than 20% down, the mortgage has to be insured through CMHC. There's Genworth and Canada Guarantee, but they're not participating in this program. The insurance premium is paid, like I said, for anyone that has put less than 20% down. If you put 5% down, your CMHC premium is 4% of your mortgage amount. So the way this works, if you buy a house for easy numbers, $100,000, you're putting $5,000 down, which is 5%. The insurance premium is 4% of the $95,000 because you're putting 5% down, and $95,000 is your mortgage amount. With the incentive program, if you put the 5% down, the government will give you an additional 5%. So then you fall under the 10% bracket. So that CMHC premium drops to 3.1% of the mortgage amount rather than the 4%. So that's right off the top, you're saving money on your premium.
And just to kind of package that, so basically it results in a lower mortgage amount since the CMHC premium is added to your mortgage amount. If you are qualifying where you need less of a premium added, it ends up also reducing your mortgage payments a little bit as well.
Exactly.
Okay. Any other main benefits of this program?
Not that I can see right off the top. There's a lot of unknowns with this program. There's a lot of unknowns, and there's a lot of cons to this program that I can see right off the top.
Yeah, well, let's go into that then. So like, what are the biggest drawbacks of the program?
One of the biggest drawbacks of the program is it's an equity program. The government has an equity stake in your property. So if they give you 5% of your purchase price and you want to sell your house down the road and it's gone up in value, they get 5% of the sale price of your home. So if your house has gone up $100,000, you have to pay them the 5% that you've already given them, plus that works out to 5% of the actual value of the home.
So if I just did a quick, really silly numbers, if you bought a house that was worth $100,000 and you borrowed 5% from the government, and they gave you that 5%, that means you borrowed $5,000. And if your home doubled in value in 10 years and sold for $200,000, instead of paying $5,000, you'd be paying them back $10,000. Is that
Yes,
correct?
exactly. Yes,
Okay.
exactly.
Yeah, so that's that equity piece. So how come you would say that's a downside to the program?
Obviously, you're going to lose out on that equity that you could have gained from the sale. Also, we just don't know there's too many unknowns. We just don't know what can happen, and the government's basically in your pocket while you own your home. So for me, there's just too many unknowns, and I can't effectively enough educate my clients on what's going to happen down the road.
Mm-hmm. And so if maybe we can unpackage some of those unknowns just so they're a little bit more clear. I'll name a couple of the ones that I've noticed from talking with you and others. Ones that this could be something that goes on for 25 years, because you could have it for up to 25 years and you have to pay it back. And it seems like there's some confusion about how exactly that will work if you're transferring it to another property or when you're selling the home. None of that stuff has really been figured out yet. Is that correct?
Well, the incentive that you get from the government is registered as a second mortgage. So you would have your existing mortgage in place as a first, and then behind that would be a second mortgage. And you have 25 years to pay it back, or if you sell the house, whatever comes first. And you pay it, like I said, whatever percentage that you borrowed is the percentage of the value of the home at that time. Now, you can pay it out earlier before the 25 years or before you sell your home, but you have to pay the whole thing out at one time. So there's no installments and what have you. So if you wanted to pay it out in, say, like 6 or 7 years, then you'd have to get an appraisal of the property, and then you would pay back the 5 or 10%, which they've given you back at that time.
Also, and that reminds me of that other kind of piece of confusion and unknown is, okay, how will that appraisal process work? Who's the one getting the appraisal? Who's paying for it? If you don't like the number that comes back, what can you do? Like, none of that stuff has been
exactly. So I would assume CMHC is putting the incentive is through CMHC. So I'm assuming CMHC would do the appraisal. And like I said, like you said, right? If because it happens all the time, appraisals come in low, come in high. It's there's the unknowns on how you can argue that, or get
or if you even can.
if you can, right? So
maybe you just got to take what they give you.
exactly, right? So it all depends. I've been doing this a long time. Appraisals can be high and some can be low. So
and is it clear or not if it would be a full-blown appraisal, or is it possible it could be an automated computer-generated appraisal?
I would assume it's a full appraisal.
Okay. All right.
And also on the other side of that, we're all assuming house values always go up. We've seen the last few years values have come down. If your value of your house has gone down since you purchased the home, then the government loses their equity stake as well. So they get 5% of the lower value. For say you sold it for less than what you paid for it, then their equity stake obviously goes down because it's 5% of whatever the sale value of the house is.
Yeah, so I guess you could say that's an upside. If
exactly.
the market value goes down, you end up paying them back less, or if it stays the same, you could end up paying them back exactly what you borrowed.
Exactly.
One benefit I guess I could see is that even though it is an equity share program, and that's how the government could get more money from you, from my understanding, there's no interest on the loan. You don't actually pay any interest payments on the loan.
Exactly.
You just pay it back plus whatever the amount that it's increased based on the value of the home. So
exactly.
I guess that's one little benefit in there that we can find.
Exactly. So that's another one of the unknowns. You could cost you a lot of money, or it could not really cost you a lot of money, right? So like I said, if the values go up, you're paying more back to the government. There's another one of the cons is it is registered as a second mortgage. So you have more legal fees because a lawyer has to register not one, but 2 mortgages. So there's additional cost for your lawyer right up front. And likewise, when you sell or you pay it back, you've got another mortgage that a lawyer has to service, right? So there's that cost for processing 2 mortgages.
So it could cost people's closing fees on buying and selling to go up just from the lawyer side because there's more work.
Yes.
Yeah, that's a good point. Okay, so I wanted to talk a little bit more about let's start maybe getting into the numbers and the income requirements. So we talked about this earlier. So what sort of income criteria is there, and how can that affect people's purchase price or their max purchase price?
Okay. the maximum purchase price that you can obtain is 4 times your household income, or 4 times 120,000. So the maximum you can have is $120,000 of household income. So 4 times that amount, that's your maximum. Sorry, 4 times 120,000 plus your 5% down payment. That is your maximum purchase price. So the rough math, if your household income is 120,000, then you can purchase just over $500,000 is your maximum purchase price.
Okay.
So likewise, if your household income is 90,000, it's 4 times 90,000 plus your 5% down payment, and then that's your maximum purchase price. So technically, if you didn't take the incentive and you just put the 5% down, and then you take the 5% incentive from the government, you could actually qualify for more.
Okay, so there is a scenario where you could qualify to purchase a more expensive home than you wouldn't have if you didn't have the program. We were talking about earlier how it seems like there's also scenarios where it'll actually reduce your max purchase price. How could that happen?
Because like I just mentioned, it's 4 times your household income up to 120,000, right? So that drops how much you actually can qualify for. So if your household income is 150,000, you're not going to be able to purchase to your maximum potential.
Can someone that does have a household income of 150,000 still use the program though, or is there possible?
But yes, you can, but you're tapped out at 120,000.
Okay.
So that extra 30,000 in
still
income,
be around that 500,000 max.
Yeah. So the maximum, so you're losing out on that $30,000 income used to qualify for your mortgage. Okay. And also all these numbers that we're talking about, that is assuming there's no debt. So there's debt service ratios that we have to qualify. So if you have a lot of debt, obviously that's going to bring down what your purchase price is. But this is assuming that there is actually no debt.
So it's safe to say that
personal debt.
Go ahead. What was that?
There's no unsecured personal debt. So like a car loan, line of credit card, or what have you, like that.
Yeah. So best case scenario, the most anybody could purchase with this program would be about $500,000, but more than likely it's going to be lower. So Vince, could you give us a scenario on how this might look for someone if they were using this program?
So the scenario I sort of was the numbers we're talking about here is a purchase of $400,000. We'll talk about basically first of this incentive, and at the same time we'll talk about it not using the incentive. So for a $400,000 purchase, if you were to buy this home on your own with the 5% down, that's $20,000. If you were to use the incentive program, you would have your $20,000 plus the government give you an additional $20,000. So you'd have a down payment of $40,000 or 10%. So the way this works out with the CMHC or the insurance premium that you must have, with the 10% down on the $400,000, it's 3.1% of the mortgage amount, which is $11,160, as opposed to if you're not using the incentive program, the CMHC premium is 4%, and that works out to $15,200. So the difference in the CMHC premium that you pay right off the beginning is $4,040. So right off the bat, you're saving about $4,000 in CMHC premium by going through the incentive program. With regards to the monthly payment, if you went through the incentive program with the $400,000 purchase, the monthly payment is $1,697. And if you went on your own without the program, the monthly payment is $1,807. So it's approximately about $110 a month savings in your monthly payment going with the program and not going out the program.
Okay, and that's because of two things from my understanding. It's because it's reduced your mortgage amount, and it's reduced your mortgage premium, which also reduces your mortgage amount, which results in a slight reduction in your mortgage payments each month.
Yes. Okay.
All right. Anything else you'd like to add about that scenario?
Basically, the numbers per year, you save about $1,319 per year in payments, and as well as about $6,598 less payments if you do the incentive program.
Okay, and so this kind of moves into a question that I've got here is, who do you think would be the ideal person for this program, and who do you think shouldn't bother with this program?
Obviously, the first-time homebuyers, the younger person that they're going to be in their home for a while, perhaps they don't have enough money to put down, but they're really sensitive on their cash flow for every month. So they really want as low a monthly payment as they can. This fits their bill. Single mother on a single income, what have you, is a great program for them because it helps with their monthly cash flow.
Okay, so someone that extra $100 to $200 a month, depending on their purchase price,
yes.
Is someone that amount could make a big difference for. That would be maybe somebody that this could be a good fit for. Okay.
Exactly.
And does that mean everybody else probably shouldn't bother with the program, or is there?
It's up to them. For me, it's not my favorite thing out there. For me, what they should have done, and the simple and easiest, is bring back the 30-year amortization for first-time home buyers. It basically, same thing, drops their monthly payment, and it increases a bit of how much they qualify for. It's quick, simple. We don't have to worry about getting appraisal, what your value is when you sold the house. Down the road, there's, the government's not in your pocket as much. But for me, that's just the quick and simple. It's easy, it's clean. A lot of brokers that I've talked to, we pretty much all agree like the 30-year amortization is probably the easiest. This can get pretty convoluted.
Well, I'm sure more of this stuff will kind of unfold. It seems like everybody's learning a little bit more about it each week as it's rolling out. Have you been getting a lot of interest from first-time home buyers in this program, or are they just trying to wrap their heads around it?
I've had questions, but nobody has yet to sort of jump on it. And likewise, talking with my colleagues, quite a few people have called about it. There's only a few that have actually used the program. So the best bet is to contact your broker and just because every situation is different, right? So there's a lot of different scenarios, how much you want to put down, et cetera, et cetera. So you basically just have to sit down and crunch the numbers and see what you're comfortable with. And what you're comfortable with possibly in the future, right? So it's basically on an individual level, but the gist of it is you're buying a house with the government.
Yeah, that's a good point. We can do as many scenarios as we want here and show numbers up on the screen, but at the end of the day, your situation is going to be different, and being able to do an apples to apples comparison to see what it would look like if you did use the program versus if you didn't, that'd probably be the best thing that you could do to find out if it's going to be worthwhile for you and make a decision from there. So I would definitely go along with that. Talk to your broker, whether it's Vince or somebody else that you're working with, and make sure you can get the proper advice and look at how it might work for you.
Great.
Any closing remarks, Vince?
Happy house hunting. The rates are extremely good these days. So, and there's a lot of houses on the market right now. So it's still a bit of a buyer's market. So, and like I said, rates have come down from last year. So there's an incentive right there, lower rates right now. And I see what the government's trying to do. I just don't know how effective it's going to be.
Time will tell. It'll be really interesting to see how many people take advantage of this and what sort of impact that has on the market. So thanks so much, Vince. I really appreciate you helping me provide a little bit more clarity for people on how this program works. And if anybody wanted to get more information on it or talk to you about it, what would be the best way for them to get in touch with you?
My cell's probably the best way to get to me. It's 780-974-6876, or you can go to my webpage at www.lendingsolution.ca, and you can contact me there, or you can fill out an application there. But generally, the cell's probably the most effective way to get a hold of me.
Cool. Awesome. Well, thanks so much, Vince.
Thank you.
We'll chat with you next time.
Sounds good.